Charlie?
Well, I already have more stocks in China than you do as a percentage, so I'm with the young lady.
Okay, well, you want to name names? Do these stocks have names? Or
No, I don't.
Carol,
This question,
I should just add one thing. You will find plenty of opportunities in China. Charlie would say you've got a better hunting ground than even a person with similar capital in the United States. Would you agree with that?
Yes, I do.
Yeah. So, and in a sense, it's logical that should be the case because it's a younger market, but still a large market. So that markets probably work toward efficiency as they age. Japan had this very strange situation with warrants being priced out of line and all of that 30 years ago. And people notice after a while it disappears, but there can be some very strange things happen in markets as they develop. I think you'd agree with that, Charlie, wouldn't you?
Absolutely.
Yeah. Jonathan?
whoa. You skipped me.
Did I skip? I skipped Carol?
Yep.
Oh,
Okay.
I'm sorry.
Okay.
Okay.
This question, and I would concede it is not a small one, comes from Gideon Pollock of Montreal. He says, the world knows generally how the looks of Berkshire Hathaway have changed since you began to run the company in 1965. Berkshire was then a tiny northeastern textile company, and now it is the number 4 company on the Fortune 500. What about the next 50 years? Could you give us your view of what Berkshire looks like in 2068?
I think it'll look a long way away. No, the answer is I don't know, and I didn't know 50 years ago what it would look like now. I mean, it will be based on certain principles, but where that leads, we will find out, and we'll have people that are thinking about different things than I am, and we'll have a world that's different. But we will be, I very much hope and believe, and we will be, that we'll be as shareholder oriented as any large company in the world. We will look at our shareholders as partners, and we will be trying to do with our money exactly what we would do with our own, not seeking to get an edge on them. And who knows what else will be happening then. Charlie?
Well, I want to talk to the younger shareholders in the group. Those of you who, after we are gone, sell your Berkshire stock and do something else with it, helped by your many friends, I think are going to do worse. So I would advise you to keep the faith.
Well,
By the way, some of that has already happened in many families.
I'll give his answer next time now that I see it get all the applause. Jonathan?
Duracell's $82 million of pre-tax profits in 2017 were still well below what it earned as a subsidiary of P&G. Can you clarify or quantify to what extent transition costs or purchase price accounting impacts at the segment level were still temporarily a burden last year? Or is it possible that the GAAP earnings contribution simply reflects a commoditization of the category given the entry of Amazon into the battery market? I did see that Duracell's earnings were up in the first quarter. Is that a sign of a more meaningful contribution in 2018 and beyond as you finish right-sizing the manufacturing footprint and acquisition-related charges fall away?
Yeah. Duracell should be earning more money than it is now, and will be. And as you mentioned, it's well on its way there, but it is not earning an appropriate amount now based on the history of the company. I was around when I was on the board of Gillette when Gillette bought Duracell, and I've seen what does when it isn't managed to its full extent. And I saw what Jim Kiltz did with it at Gillette when he ran it. And there were a lot more transition problems in the purchase. For one thing, there's a lot of rules connected with our swap of our stock in P&G for Duracell. There are a lot of things that you cannot do that made sense to do in that period of transition from P&G's management to ours. But Duracell, the brand is strong, very strong. The product line is very strong. So and we are making more money, and we should, and I believe we will, earn really what the property is capable of earning. We should be earning that relatively soon. But you're absolutely right that it is, from a profit standpoint, is underperforming. We're making a lot of changes, and some of those are involved in jurisdictions, countries where it is really expensive to change in terms of employment payments that have to be made if a plant is changed or something of the sort. But I like the Duracell deal absolutely as well as when we made it. Charlie?
I like it better than you do.
No, Duracell is a very, it's our kind of business. And
It is.
Okay, station 7.
Good morning. I have a question related to the bond market, the U.S. Treasury bond market. My name is Ole Larsen. I live in the San Francisco Bay Area, and I never worked in the financial industry. I started out buying penny mining stocks on the Vancouver Stock Exchange, and then a decade later I got married, and my wife convinced me to buy Berkshire shares. That was probably a good decision. So my question is, I read the newspapers about the Federal Reserve and the inflation numbers, and there must be an increased supply of treasury bonds that must go to auction. And my question is, what do you expect that to impact yield or interest rate?
Yeah, well, the answer is I don't know. And the good news is nobody else knows, including members of the Federal Reserve and everybody. There are a lot of variables in the picture. And the one thing we know is we think that long-term bonds are a terrible investment. And we, at current rates or anything close to current rates, so basically all of our money that is waiting to be placed is in Treasury bills that I think have an average maturity of 4 months or something like that at most. The rates on those have gone up lately, so that in 2018, my guess is we'll have at least $500 million more of pre-tax income than we would have had from the bills last year. But they still, it's not because we want to hold them, we're waiting to do something else. But long-term bonds, they're basically at these rates. It's almost ridiculous when you think about it, because here the Federal Reserve Board is telling you we want 2% a year inflation, and the very long bond is not much more than 3%. And of course, if you're an individual and you pay tax on it, you're going to have some income taxes to pay. And let's say it brings your after-tax return down to 2.5%. So the Federal Reserve is telling you that they're going to do whatever's in their power to make sure that you don't get more than 0.5% a year of inflation-adjusted income. And that seems to me I wouldn't go back to penny stocks, but I think I would stick with productive businesses or certain other productive assets by far. But what the bond market does in the next year, you've got trillions of dollars in the hands of people that are trying to guess which maturity would be the best to own and all that sort of thing.